Good morning, everybody, or hello, whatever time of day it is you're watching this video. My name is Kian, I'm from Car Bookkeeping Specialist, and we're going to finish off today how to calculate your corporation tax. It is really simple and easy to do. There's a couple of ways to do it. If you do have a profit and loss that's already been drawn up for you, you can calculate it very easily from there with only a few minor changes. But if you don't have a profit and loss statement, then I'm going to be showing you how to calculate your corporation tax in 4 really easy steps today. So let's go through that process quickly together now. Step 1, add together your sales for the year. So when I say the year, that means the accounting period that you're looking at to be declaring whenever it is that you're submitting your corporation tax return, and any other interest or income that you might have incurred during that period. So that might be interest, for example. Step number 2 is to add together all of your allowable expenses, so salaries, materials, office equipment, etc. And then step number 3 is that if you've got included in those expenses that you've calculated things like depreciation or certain types of client entertainment, you can't actually deduct them from your income, so you have to add them back, and I'll show you how that works in a second. After that, you'd have worked out if you've made a profit or if you've made a loss. If you've made a profit, then you'll calculate the amount of corporation tax you have to pay, which is the 19%. And if you've made the loss, then you don't pay anything. You can carry that loss forward into the next year. So how to calculate your corporation tax? It's 19%. How do you calculate 19%? Take your profit amount, divide it by 100 times by 19. That's how you calculate a percentage. So let's take a look at an example. Step number 1 over here is the total sales income, okay? So in this example, it's £200,000. Now, if you've been following any of my previous videos, you would have seen sales forecast. So if you're doing a sales forecast and then you're updating it as month by month time goes on, you're putting in your actual figures as opposed to leaving in your budgeted figures, then that total at the end of your period or your year will be your sales income. You just put that figure in here. Then you'll calculate your direct cost or your cost of sales. So that will be all of the costs that are directly associated with each unit of goods or service that you're selling, and you add those up for the year. And you'll also include any sales returns. So if you had to give any refunds during the period, then put that in this section as well. Total them up together and calculate your gross profit. So that is your sales income minus your cost of sales. That gives you gross profit. There are several different types of profit. When you hear people talking about profit, it's always a good idea to ask them, which profit are you talking about? And I do have a few issues with the way people use the word profit. I'm not going to go into that today. I'm going to do a whole series on different types of profit for you guys later on, but just bear in mind that that gives you your gross profit. After that, you'll remove all the other expenses. So all the other expenses that I said that would be allowable, and that brings us to step 3. You total them up together, and if there was anything in there that was not allowable, so for example here we include depreciation, then you'd have to add depreciation back. So to get this figure here, which is profit before tax, you'll say gross profit minus your total expenses, all of your expenses, plus back on anything that you're actually not allowed to deduct, in this case depreciation. Okay, so I hope that's clear. Let me show it to you. Equals gross profit minus total expenses, add back anything that you weren't allowed to deduct. And last but not least, step 4 is to calculate the tax amount, which is 19%. So you would just say equals profit before tax, that figure that you just calculated, divided by 100 times 19. That will give you 19%. And then that's what you need to be paying over in corporation tax. Whatever you've got left is the retained profit in your company, and that would often be used to go towards paying your dividends or being retained within the company to be used again following years, etc. So it's really that simple. If you do have any questions, please feel free to get in touch with me. You know how to contact me by now. Don't forget to leave me a message, comment, like, subscribe, share and follow and all that good stuff. Thank you so much, guys. I'll see you on the next one. Bye.